Going to be talking all about employer plans that can be self-directed here at Quest. I'm really excited for today's class with none other than the president of Quest Trust Company, Nathan Long. Now, before we get started with today's main presentation, I do just have a couple of quick announcements for you guys, kind of as we let people get signed on here, kind of let you know a little bit about some updates with what we have going on right now at Quest, our events, and a really exciting big online conference that we actually have coming up in December that we just announced here in the last couple of weeks. So to go ahead and get right into it, just a quick commercial about Quest. Here at Quest, at the core of our business, we are a self-directed IRA custodian. So we basically teach investors how to utilize their old 401ks and IRAs to invest into assets outside of the stock market. So our clients self-direct their IRAs into real estate, notes, private placements. You really have a lot of options when you're investing with an IRA. And one of the biggest benefits of doing this is it really allows you to diversify your retirement portfolio into, non-traditional and privately held assets. And all of the profit that you make from these deals actually goes back into your IRA without being taxed. So it's a really great way to shelter your investments from these income taxes and capital gains taxes each year. Now, we're a pretty good sized company. We've got about 20,000 active clients nationwide. We are physically based in Texas, but we do have clients in all 50 states. But most importantly on this slide here is our bright yellow disclaimer here at the bottom. Please be aware that at Quest, we put on a lot of education. We bring in a lot of different guest speakers, but we are not able to give tax, legal, or investment advice. We put on a lot of webinars, a lot of in-person events, but just please be aware, do not rush into deals with people that you do not know, and make sure that you take the time to use professionals to structure your deals properly and make sure that you've done that proper due diligence there. But if you ever have questions, we're always happy to help. I do actually have one of our IRA specialists online with me today. His name is Logan. He's actually based out of here in our Houston office. And fun fact, Logan has literally worked in every single department at Quest. So if you guys have questions throughout this webinar, be sure to send him a quick chat and he can help to get those answered for you. Now, fair warning, these next couple of slides have a lot of text on them. It is something really important that we are including in all of our classes right now. There's been some recently proposed legislation. It's a $3.5 trillion budget reconciliation bill. And there are actually several sections of this bill that could directly impact self-directed IRAs, Roth IRAs, and your ability to hold certain types of investments in your IRA account. Now, before I get into these next few slides, again, there's a lot of text here. We can send you this information if you want to read this exact breakdown, but we have several resources for you guys. The main one that I want to touch on here today is private placements. So if this bill passes with the way that it is currently written, after the end of this year, you would essentially no longer be able to invest your IRA into any private placement that requires you to meet some sort of pre-qualifying criteria. This includes private placements where you have to be an accredited investor, sophisticated, some sort of pre-level of education there. And not only that, but after the end of this, for any investments that are currently held in IRAs for private placements, they would actually lose their IRA status in 2023. Now, my next slide, I will have some details where you guys can actually help us make some noise about this and reach out to your local senators, district representatives. And I think this is really important. So at Quest, we have actually done quite a bit of action on our end. We're teaming up with other players in the industry to, kind of really make as much noise as possible. But this bill was really drafted to kind of eliminate people from building up just tens of millions of dollars in IRA accounts. But what they don't realize is in the mix of this 800-page bill that's been proposed, it actually has a really big impact on the average investor. So if you have ever invested your IRA into a private placement, if you've ever used a self-storage facility, even for your own personal stuff, this is going to affect a lot of people. It'll affect a lot of, companies in our industry. So do us a favor, do some research about this bill, and this QR code actually takes you to a page on our website where you can find webinars, blog posts, and I also, if you can put in the chat John Hyer's website, it's not in this slide here, but there's a really awesome website set up for you guys by John Hyer. He is one of the top players in our industry. He's an IRA and tax attorney. This website is called handsoffmyira.com. So that's handsoffmyira.com. I love the play on words there. But if you guys go to that website, it has an exact breakdown of what's in the bill, the most current updates that John had. He posted a webinar actually last Thursday about it. And it actually has pre-written templates that you can kind of fill in the blank, personalize, and send directly to your representatives. The best chance that we have of either stopping this thing or have edits made to it where it wouldn't quite affect these investments as much, really is for as many people to make as much noise as possible. So if you have questions about that, let us know. I know it's a bit of a heavy topic to start out today's webinar with, but I do think it's really important that you guys are aware of this and that you're taking action today to hopefully help us make some noise and help put a stop to that. Now, I've said this in the last 3 webinars that I've introduced, but it feels really awkward to go right into our events after that kind of heavy topic there. But the next couple of slides are a little bit lighter for you guys. We have a lot of really great upcoming events. Most of them are still online, but we have actually brought back our in-person mixers here in our Texas offices in Houston, Austin, and Dallas. If you guys are local to any of these 3 cities in Texas, come see us. It's been almost like a year and a half to 2 years now. We're really excited to be opening up our offices again and really kind of recreating that hub for you guys to come learn and network with other real estate investors so you can add people to your power team and, find people to potentially do deals with. So we have brought back our mixers. We have rebranded them as the Self-Directed IRA Social. And our next social is actually tonight in Houston. Nathan will actually be there in the flesh, in person, teaching a class over raising private capital for your deals and private money lending. So that should be a great class there. If you're not local, you can still watch all of these events online, just like you've been able to for really the last year. If you're in Austin or Dallas, we have the socials coming up later this month. And we really do ask that you guys please RSVP. We are capping these events at about 50 attendees. So we've got plenty of space for you guys, but just make sure to get that RSVP. Otherwise, we'll probably give you a bit of a hard time at the door. Now, we do have some other classes coming up. You can find all of these on our website. Logan will post a link to our events page on our website. There you can find all of that information. And you can also rewatch all of these classes on YouTube at any time. Our YouTube is a fantastic resource. We've really put a lot of effort into putting all of our education on our YouTube channel over the last couple of years. So be sure to check that out. And we've also got a virtual networking happy hour. It's twice a month. It's great for you guys to come in and meet with us online. You can actually talk to other investors. Everyone gets a chance to share their cameras. And the next virtual happy hour, I will actually be hosting it myself tomorrow night, Wednesday, October 6th at 6:30 p.m. Central Time. So be sure to check these out on our website. You can find everything right there. All right. My last announcement for you guys is our big online conference. We have brought back QuestCon Live. It's our biggest online conference that we've been hosting about once every quarter to once every 6 months throughout the pandemic. And this is going to be a great event. It's a full 2-day online conference. We have about 20 different guest speakers. And the theme of this month's QuestCon is all about forecasting 2022. So I think we can all say this past year and a half has been a little bit crazy, a little bit out of the norm. There's been a lot of crazy things going on in our industry. So if you want to start out January on the right foot, to really get started and kickstart your investments into the next year, be sure to join us for QuestCon. Tickets are on sale now. This is one of the very few paid events that we host throughout the year, but I can guarantee you the quality of education and the amount of guest speakers you're going to see is definitely well worth that ticket price. I think they're $49 right now. They're on pre-sale through the end of this month. So be sure to get your tickets or get them in November when they're a little bit more expensive. Either one works for me. So That's all I've got for you guys. Here's our contact info. But if you want that, Logan will plug it in the chat for you guys. Without further ado, let's go ahead and get into today's main presentation over the various employer plans that we have here at Quest. Nathan, go ahead and take it away. I know you've got a good PowerPoint planned. If you guys have questions, put them in the Q&A box and we'll be answering them throughout the presentation for you.
This is a pretty short presentation. I'm going to go over some employer plans. Again, if you guys have any questions, all you have to do is put them in the chat box, and they'll even interrupt me as I'm talking. Logan, just stop me. It's okay if anyone wants to know anything or has an idea for something or anything like this. So we're talking about maximizing your things. There's all different types of accounts that can be self-directed at Quest. Disclaimer: we don't give tax, legal, or investment advice. Haley already went over all that. All right. The different types of accounts that can be self-directed are traditional and Roth IRAs. We spend a lot of time talking about those because most people's money's in a traditional IRA. If it came from a 401k or a 403b or some type of qualified plan, that's where it is. And we have a lot of classes where we love to teach people about how to use health savings account and covered education accounts, especially health savings accounts. They're so important. They're going to be one of those cornerstones of wealth building going into the future for sure. And understanding how self-directed one's so important. But today we're in the center of the slide. We're talking about employer plans, right? SEP IRAs. We're going to spend a little bit of time on simple IRAs. They don't really apply too much to us. And then we'll cap it all off with a very important discussion about solo 401ks, which could be very, very relevant in today's market. All of those different types of plans can be self-directed. And what I like to encourage people to do is learn how to partner them together, or bring your IRA with your SEP IRA, with your health savings account, and all put them together into one investment. There's a lot of advantages for you doing that, whether you're the lender, the borrower, raising money, whatever you're doing, there's a lot. And if you heard some other classes, you hear me talk about this a lot, so I'm not going to spend a lot of time talking on here. I am going to talk a little bit about the things that you can't do with IRAs, because I think it's important. Again, most of this information is in other classes, and I want to spend most of my time speaking about the employer plans, but it's really important to understand what you can't do with IRAs, right? And the biggest thing you can't do with IRAs is deal with a disqualified person. There's people who can't buy, sell, trade, extend services, or receive a benefit either directly or indirectly, and that is basically you as the account holder is where the list starts. And the idea is your IRA is for your future. It's not for you to use right now or get a benefit right now, right? You can bring all your knowledge to bear on your IRA to make it grow, to make it bigger, to make it better, but you can't have a benefit. For example, if your IRA bought a house, it could do that just fine. All the expenses would come from the IRA. All the cash would go back into the IRA, making it bigger, right? And you couldn't live in that house. We could only rent it out. It's all that income has to be for the benefit of the IRA. Your benefits down the road, when you take that money out, when you distribute it to yourself, that's when it becomes your benefit there. In the meantime, you're like a trustee for this account. Again, you can bring all your knowledge. If you know how to do something, if you know how to be a real estate investor, if you're doing all these things, you can bring that knowledge and bring it to bear on your account, and your account can have an advantage, but you personally can't get an advantage. In addition to that, there's a group of people who are equally disqualified to the IRA. Well, we wrote this list, but it's easy to remember. It's you and your spouse, your children and parents, their spouses, and companies those people own, control, manage, or highly compensated by. So you can't throw an LLC or something like in there, and it's like a magic washing machine. New laws might not even allow any type of LLCs or single management type of entities to ever be in IRAs again. Hopefully it doesn't come to that, but that could happen as well. Notice I didn't say family. I was very specific. You, spouse, children, parents, their spouses, right? Because it's really important to be able to identify the people that you can do business with directly, in other words, borrow, sell, lend from, and the people that only way you can do business is through partnering. like my IRA and my wife's IRA may partner on a deal where we lend somebody some money or something like that. And again, if you want more information on that, we got plenty of classes about disqualified people and prohibited, and we have Logan online, and he is a prohibited transactions specialist, especially after working in transactions all those years. All right. And again, we have prohibited transactions, and that's pretty easy to explain. That's just the things that people can't do. And I've already been really saying it, which is you can't buy, sell, trade, loan, extend a service, or receive a benefit either directly or indirectly. Like, hey, I'll loan you some money if I can use your boat on the weekends or something like that. That'd be an indirect benefit as an example. So that's just the kind of things. So let's dig into it. There are 3 types of employer plans that we have at Quest that you can self-direct. And if you look at the Quest, we've broken it up into different categories. We had the personal plans, and then we had the employer plans, and then we had the specialty plans. It's like a menu. You get your dessert or your appetizer, your main course, and then your dessert. For most of us, our main course is our employer plan that is often, like me, I'm a W-2 employee of Quest, and therefore my employer plan is at Quest, right? But if you either have a small business, you're self-employed, all right, or some type of contract employer, you may be interested in one of these employer plans. Everybody can have an employer plan out there that has earned income of some way or some sort. So let's look at the different types. The first one is not very often used, and it's because the other 2 fill it in so much better than what this one does for most people. It is called a simple IRA. And it's really funny that it's called the simple IRA because it's actually one of the most complicated type of IRAs out there. It was designed to mimic a 401k for small businesses where you had employer and employee contributions. But unlike a 401k, there's no administration that's needed to be done by the employer. Once the contribution is made in there to the employer from the employer, then it is completely managed by the employee. Honestly, this only works like in small businesses where you might have some family-run people or a lot of part-time people and you want certain people to get it. Most of the time, one of the other types of plans seem to work better for most people, especially under the self-directed world, because you don't really want to self-direct any of your employees' investments, right? So most of the time, we don't see a lot of this, honestly, okay? The employer does contribute. The employer typically contributes 3% each year. Okay, and then the employee has an amount that they can contribute, which is up to $13,500. If you're over the age of 50, you can contribute an additional $3,000 if you want it. There's no employer filing requirements because as soon as the money's placed into the account, it is all belongs to the employee, and they can do whatever. You can't borrow any money from it or use it as collateral in any way, shape, or form. And there is an unusual thing with the simple IRA. Once you open it and put money in, you have 2 years before you could take it out and do anything, even move it to a like type of account. All right. So if you want to move it to a traditional IRA or something, that simple has to be in for two years and before you can do that. And if you don't, you pay this horrible 25% penalty. So just a thought. But after it's been open for 2 years, then you can do your transfers and other things like other accounts. Again, I'm not going to spend a lot of time on this because it does affect most people. I want to talk about self-directing SEP IRAs. And a lot of people out there have SEP IRAs. And the reason why people have SEP IRAs is usually because it solves a tax problem often for people. Let me kind of explain to you how a SEP IRA works. A SEP IRA is really a traditional IRA, but they've allowed for employer contributions to it. Okay, so if you're self-employed or your employer can also have a SEP IRA plan at their business, you'll find that most businesses don't. I'll explain to you why, if you have a lot of different employees, why they don't use SEP IRAs. But with SEP IRAs, they're pretty flexible. Matter of fact, you could even make your traditional IRA contribution right into a SEP IRA. And then once it's in there, all the rules for traditional IRAs apply to SEP IRAs. So you can do immediate conversion if you wanted to, if you qualify for those, right? Right now, anybody can qualify, but with the new law coming in, they're going to put an income cap. Married filing jointly, taxable income of 450. Once you're above that, you can get a convert. Some of you have been thinking about converting, might want to do it this year prior rather than waiting for next year, because you might lose that opportunity next year to do a Roth conversion. Something to think about. And the way SEP IRAs work is whatever you have for your income, when you get done stating it, you basically can put about 20% of that money into the SEP IRA account. And it kind of depends on how you get paid. And it's important to understand that. So if you say you're a realtor and you have a W-2 company, which some people have now set up, even though they're self-employed, and you're employed under that plan, well, and if you have taxes withheld, then it's 25% of your net pay. If it's Schedule C earnings, it's 20% of the net Schedule C earnings. You really need to go see your tax professional to get the proper contribution amount. So it is based off of a percentage of how much you earn. All right. It's very easy to set up. There's no filing requirements, and only the employer contributes. Now, sometimes we're self-employed. You got to remember, we're both the employer and the employee in some of these. You have a maximum amount that you can contribute into a SEP IRA each year. It's $57,000 for year 2020, $58,000 for year 2021. It does not have any catch up. So if you're over the age of 50, there's not an additional amount that does it. And again, there's no filing requirements, nor can you remove or have loans to yourself or take or use it as collateral. You can remove, just like you can with a traditional IRA, anytime while you're still in one, you can remove it. But if you're under the age of 59 and a half, will be an additional 10% penalty. And of course, it would add that taxable amount to your modified adjusted gross income. So why do so many people have SEP IRAs? Sorry, coffee sip. All right. So many people have SEP IRAs because it goes like this. I'm a realtor, or some type of contractor. I'm an engineer or something. I'm self-employed. Boy, did I have a good year. Woo! Made all this money. Hadn't quite figured out all my taxes yet. So come April 15th, what I'm going to do is I'm going to file an extension. File my extension. I'm all happy. And I wait around until somewhere, just before October starts. And I call my tax guy and I finally get my taxes together. And he goes, boy, oh boy, you had a good year. I said, yes, I did. Okay, here's your tax bill. And you go, oh my God, what can I do? And your tax guy goes, well, there's really only one thing to do. See, employer plans allow you to make contributions to them past the tax filing deadline, all the way up to the tax filing deadline, plus the extension. And that's why I'm still listing on this particular slide the 2020 maximum contribution limits. Okay, you can see they're pretty high if you had enough earned income in there. It's because people are still making that contribution to the SEP IRA right now for last year. Okay, and that's what happened. Like, you can sit down with your CPA and CPA basically have two choices. You can write a check to Uncle Sam, or you can write a check to yourself for your future, and most people choose B, and that's how most people start their SEP IRAs. Almost everybody I know, typically you keep making contributions after you figure it out, but I always find everyone that has SEP IRA that's like, yeah, I got a tax problem. That's how it started. So it's really important to kind of understand SEP IRAs because they're extremely flexible. They're easy to use because of they're cheap. there's nothing, they're no more expensive than opening a traditional IRA or Roth IRA or anything else like that. So very cheap to administer, and highly used and work very, very well. One of the things you need to know with them is you do have to know how to calculate your contribution limits, and you'll probably need tax help to do that. So that's important to understand. Another thing, the reason why they're often not used, I don't know if I put this in a slide here, is I think I already talked about this slide where it's either 25 or 20% of net earnings. But one of the reasons why this account isn't often used is as if you have employees, like if I had Quest, it's because if you make a contribution percentage for yourself, if as a business owner, it must match the same for everybody else. So if you wanted to put 20% of your wages aside for retirement, then everybody that you employ would also that year receive 20% of their wages set aside. Again, that's why typically SEP IRAs are only used for self-employed persons and very small businesses. As you get a big business, it just doesn't make sense. There's probably an actual qualified plan like a 401k that works better for most employees. Any questions there? Doesn't look like it. Kind of brilliant or baffling. It's important to understand the way you make contributions to SEP IRAs, because this is going to apply to the next subject that I'm going to talk about, which is probably the most powerful account out there in self-directed world, which is the solo 401k. Sometimes this is referred to by some people as an individual 401k or something like that. Well, what's different from a solo 401k than a 401k at your employer? Like you work at a company and have an employer, like I work at Quest and I have a 401k at Quest. Well, what would be different about that? The difference is at Quest, right, as the employer, I have a lot of responsibilities that I have to do to my employees, and those responsibilities are put on there for good reason, because there were employers that were walking away with their employees' retirement money, right? Bernie Madoff, blah, blah, blah. So those restrictions are in there for really valid reasons. And so you have to have actuaries, third parties that look at it, and all types of balancings and stuff that take place. There is a responsibility to me. Well, and that's a very complex part of having a 401k or qualified plan. If I have a company and the only employee is me, I'm the employer, I'm the employee. That's it. I have no other common law employees in this company or any other company. What happens there is they've said, you could just erase all of those responsibilities off the table. And it greatly simplifies the 401k. And the reason is are you going to steal from yourself? Probably not. And if you do, well, it's your fault anyway. Okay. So it makes sense that you could take it off. But as soon as you add those common law employees, now again, this is probably one of the most powerful accounts out there. I'm going to tell you all the cool stuff about it. And then I'm going to tell you some reasons that, there's some problems with it. Because with everything that is powerful, it is also dangerous. And this is a very powerful but very dangerous tool. Let's take a look at it. All right. First of all, who should have an individual 401k? I mentioned it. You have to be self-employed. You can't just have a 401k because you just, hey, that sounds really cool, I want one. You have to actually demonstrate 401k income. Now, to be clear, I have clients that are W-2 employees. They work for a company, but they also have self-employment income. They have some type of, they do consulting, or they get commissions or something like that outside of that on the side. They can also have a solo 401k representing that other things, as long as they don't have any common law employees. And that includes, there's grouping rules that deal with benefits. So that includes not only the company that we're talking about, but any other company. For example, Haley is an employee of Quest, right? If Haley had income outside of Quest because she cut hair, let's say, she could have a solo 401k. Whereas I'm also an employee of Quest, but because my ownership of Quest exceeds a certain percentage, it is deemed that I have common law employees. Therefore, I couldn't have a solo 401k because I have common law employees at Quest, even if I had income outside of Quest from my haircutting business. Does that make sense? Have any questions yet, Logan? Moving on.
Yes.
See some chat.
We do have one question. One of our attendees says, my understanding is that I can roll over money from an employer-sponsored 401k to a solo 401k without the concern of contribution limits. Is this correct?
Oh, no, that's not correct. I'm so sorry. I'm getting to that. But in order to have a solo 401k, there is a process called legitimizing. All right. And in order to legitimize a 401k, you have to demonstrate having self-employment income. And how do you do that? Well, you demonstrate that by showing it on your tax return. And then in at least the first year you have the solo 401k, you make a contribution to that 401k. This contribution cannot be a rollover contribution. It has to be a direct contribution from a solo 401k. And you've asked a great question because so many people have been talked into a 401k. A 401k is better than an IRA. Yeah, it is. There's a lot of cool things about it. I'm about ready to tell you all those cool things. But not everybody should have one. And you have to qualify for it. The problem is the way most people do is they charge for your package up front. So you give a big check to the administrator and they peace out. They have a good reason to just not give you all the education as to what you need in order to have a successful 401k. So often when I'm talking about 401ks, I find people who have already gotten to a 401k, and in a very brief conversation with them, I find out they haven't properly legitimized it, which can blow up the entire account. If that's what you're in, you should call Juan Deshawn at my office and just have a conversation with him about what you're doing. Juan Deshawn's one of our 401k experts. He's a manager at Quest and has been doing this a little bit and can possibly help, right? But that's a concern that I really have for a lot of people. And again, powerful tool, but very dangerous whenever it's not used correctly. Talk about it. Go ahead, Haley. What else you got?
And yeah, and just to clarify on that one, now say I do meet the requirements for the solo 401k, I've made my contribution, I've legitimized it. Can I still roll over funds from another employer 401k?
Yeah, you can employer plans, SEP IRAs. You can move almost any type of fund into a solo 401k except for one, and that's a Roth IRA. A Roth IRA can only become one thing. It can become either a distribution or it can become a beneficial IRA, but you have to die for that to happen. It never can go back into an employer plan. Everything else can be put back in there. And as of right now, we can do conversions inside the plan, and we'll see that we can also make Roth contributions to the plan no matter what. Something else, here's why we're talking about cool things about the plan. The plans are not affected by this current legislation, which is forcing people to distribute their PPP loans, their private placements that they have out there in 2 years. If that happens, there may be the opportunity to figure out how to create some self-employment income, legitimize a 401k, and move it in before it happens, and we might be protected from it. So I'm excited that they might have left a door open for some of us to use, though it might be a complicated door to use because you're having to roll over an asset from a plan and some other types of things. But hopefully we won't come to that, but we're working. More questions, or I keep going? Okay, I can keep going and you stop me if you need to. All right. So, oops, here she comes. Oh, I got the thumbs up. There we go. All right. So I'm going to give all the advantages and I'll recap about the disadvantages. I kind of crapped you out at the beginning by giving the disadvantages first, but that's how the questions came in, right? One of the big advantages of a 401k is what we call checkbook control. So me and Quincy for years have been telling people, man, do not have what we call a checkbook control in your IRA. The IRS is coming to get them. We've been saying this for 10 years. No one's believed us, but here we are now. They are. All right. So a lot of people say, oh, I take an LLC, I make myself the managing member, and I have checkbook control over my IRA. That's always been a bad idea. All right. We've always instituted to you could have that LLC in there, but put someone else as the managing member. But with a solo 401k, you're the trustee. You hold the checkbook, baby. You could have an LLC in there. It wouldn't disqualify it at all. You could be the managing member. But you don't even need it. You literally write the checks. You're signing the documents whenever it comes to closing. Everything is handled through you, right? This is an advantage, and we'll also find out it's a disadvantage at the end, but it's super powerful. For those of you that are doing rehabs and heavy work, if you can qualify to have a 401k over an IRA, a lot easier to manage in that way, all right? The next thing, you could dump a lot of money into these, because you can make larger contributions than you can with other types of plans. And why is because you get to contribute as two people, the employer and an employee. And your employee contributions can be either traditional or can be made of Roth right now, regardless of your income. All right. So, for example, the employer contribution works exactly like what we were just talking about with the SEP IRA. Okay. It is 20% of net earnings from Schedule C or 25% from W-2 wages. Okay. Not to exceed $57,000 for 2020, $58,000 for 2021. But the 401k does have significant catch up that allows it to jump up to 63.5 and 64.5, right? If you're above the age of 50, it's got a $6,500 amount of catch up. Now, the catch up is on the employee section, not the employer section, but it bumps up the total amount that we're allowed to put into it. As an employee, you can put up to $19,500, right? Didn't change either year, and it has the catch up. And again, that can be made as a Roth contribution or a traditional contribution as you go along. Let's see, what else was I going to say here? I think I covered it all. Sorry, just a slight pause. Here's a weird one. You could loan money from your 401k to yourself. It's the only account out there that you can do it. You can actually give up to $50,000 or up to 50% of your balance and loan money to yourself. You pay it back at a 5-year amortized rate of market rates. I don't recommend it. I always think that if you want money or you need money to borrow for something, just go borrow from someone else's IRA. But I guess it's definitely an advantage. Some people like to take money out of their 401ks for a loan to themselves personally. All right. But one of the biggest advantages of this type of account is an exemption on UDFI, which is unrelated debt financing. And what I mean by that is if we buy a house inside an IRA to the extent that it is debt leveraged, we have to pay tax on that profit to that extent. For example, I bought a house for $100,000 and I put $60,000 down or $40,000 down. I got a $60,000 non-recourse loan from someone like North American Savings Bank because the loan must be non-recourse. And I sold that house. If I had done it in less than a year, I'd have to be taxed at ordinary income, but 60% or the percent I had debt leverage would then be subject to a taxation. If I held it over a year, it would be at a capital gains rate instead of personal income rate. But either way, I'd have to pay tax on it. And if you do that exact same deal inside a 401k and you've held it for over a year, it doesn't work for less than a year. But if you've held it for over a year, it literally wipes this tax off the board. It just goes away. And I can't honestly think of a more powerful strategy than buying real estate, using somebody else's money, leveraged in a account that can be leveraged as a Roth IRA, Roth account, right? So that it's growing completely tax-free. It doesn't get any better than that. And I don't have to pay any tax on under the unrelated business income tax. Now, here's one of the areas where I've seen this super powerful. I've known people that buy into an apartment complex, and they do well. They're a passive investor, and they found out they're going to make a whole bunch of money, and then they realize that their IRA is going to have to pay tax on that money, because though it wasn't an LLC, which is a pass-through entity, as that creates tax as it creates income, that asset was debt leveraged. It's a debt leveraged asset. In other words, we had a loan on the apartment complex typically, and that creates taxation. I've seen people be able to legitimize a 401k, move that money into that account, and then be able to bypass that taxation, even though they just did it, because they held that property for over 2 years and the profit hadn't been realized just yet. Usually it takes a little bit of time for the profit to realize. So I've had people actually, it's like throwing a lifesaver to someone that on a tax that they didn't realize they have. It's a complicated subject. A good class to have an understanding on this, I have 2 of them, is Problems and Solutions and Understanding Real Estate. Both these are on the website. Problems and Solutions and Understanding Commercial Real Estate. All talk in depth about unrelated business income tax. Quincy also has some really thick classes on there as well. Logan, if you find any links to those, throw them up in the chat box as well. Any other questions here as we're going on?
Oh, yeah. We've had some come in. Some of these kind of relate to the like the contributions and income slide. Someone asks, if I am a 1099 employee, is my income considered self-employment income so I can contribute to a solo 401k?
Yes, typically, again, you want to ask your tax advisor. For example, I could have 1099 income, but then if I took it all down to 0 because I expensed it all away, then I don't have any income anymore, right? But yes, that's typically where it starts. A 1099 income is what will allow you to have a 401k. And here's the other thing. You don't really have to make that contribution each year. It's unclear with their guidelines, right? Because you could have a year where you didn't make any money and you don't have to close down your account. So that contribution, that legitimizing, only happens in the first year. Now, I would try to legitimize every several years at the very minimum to make sure that anyone's looking at it, it looks squeaky clean. And I'll talk to you why. What other questions you got, Miss Haley?
Yeah, so this one's kind of along the same lines, but if you have any other insight to add here, one of our attendees just kind of asked a little bit more vaguely, can you address earned income requirements for a solo 401k?
Yeah, I mean, it really earned income requirements. Anything that you show on your tax return as earned income, that's where the requirement comes in, that you've paid tax on it. That's how you know it's there. For example, it's easier to talk about what wouldn't be. For example, Social Security income wouldn't work as it. Most alimony income wouldn't work, or disability income wouldn't work. What would work is I worked as a hairdresser. I got commissions from a real estate deal. Other things that don't work are income from, let's say, real estate properties, right? If we have rental properties, and those typically we're avoiding taxes and putting those over in a different quality or Schedule E investment income. And as soon as your tax person puts that over there, which is wise to do, that won't be used. So most of the time, our real estate earnings, like rental properties, money from flips, things like that, also aren't qualified. So earned income, the term earned has a meaning to it. In other words, I'm earning the money and I'm paying my full tax bill on it. Social Security, both sides of the employer tax, that type of stuff. Hopefully that helps.
Yes, that was a great answer. And last question, at least for right now. Someone says, I read in the Secure Act Or I read that the Secure Act provides for an entity to establish a 401k plan retroactive for the previous calendar year if done by the tax filing deadline with extensions for that year. Is it too late to establish a self-directed 401k and make contributions for the 2020 tax year?
Ooh, that's an answer I hate to answer online, to tell you the truth, Haley. The reality of it is that it's not too late to make contributions to a 401k. You can do that all up to the filing deadline. The idea was that you were supposed to have your 401 place, or what we call your plan documents, in place by January 31st. There might be some ability for you to predate that or whatever. There's plan documents are just signed and put into a thing to sign. So we'll just leave that, not have a lengthy discussion about that, but could be ways to have that happen.
Yeah. And we can talk more about that one-on-one. I did plug Juan's Calendly link as well as his email in the chat for you guys. So if y'all want to set up a consultation for those questions, that's a really great resource for you there. That's all I got for now.
All right. So I'm really just about done with this, Haley, but there are some disadvantages to these accounts, and it's important to pay attention to them. The disadvantage one we've been talking a lot about is legitimizing. In other words, I have to be able to make that current year contribution. But the other thing is there's a big difference between a solo 401k and, say, an IRA, and that we're not in the picture. Once you've got it, you're up and running. You're just making the decisions by yourself. So you can always pick up the phone and call Juan. Education services are free at Quest at any time about every transaction and kind of go over it, but most people don't, right? And you find a lot more prohibited transactions that occur just because you don't have that oversight, of someone being obviously there. So it can be dangerous of that. And one of the biggest dangers of it is the actual bookkeeping. It can be very complicated to do bookkeeping on these, because remember, you're making traditional contributions, you have a rollover contribution, you have money coming from an IRA, and no one's helping you with this. You're having to do this bookkeeping, and you may invest these separately or together. Now, I have a presentation just about 401ks that Juan can send you if you're interested in 401ks, that will go a little bit more in depth about the record keeping of different things. But if you mess it up, it's really easy to do. And the last point is you don't have someone doing your IRA reporting. At Quest, we do IRA reporting for you with but once you're on your own with the solo 401k, you've got to do this yourself. So if you do a 1099, or you distribute, or you transfer over, you're going to have to report those things. In addition, there is annual reporting that has to be done if the account reaches over $250,000 as well every year, reporting the values and what's in the account and different things. They can be difficult to get right, and I highly suggest that you have competent accounting advice if you want to run one of these types of accounts, or be very, very good at it. I mean, I know that you guys think that it's very easy to learn some of this stuff, but it took Haley, who's a smart girl, 4 years to become an IRA specialist. That's a long time. And I'm trying to get to you that if people would just slow down and pick up the phone, it'd be okay. But this can be very dangerous. And the last thing that I want to tell you about, this is a definite audit trigger. I've been saying it for years, but now I've got lots of confirmation. If you have a solo 401k, a lot of people make a lot of mistakes. A lot of people do a lot of dumb things, and they're able to catch you really easy. It's low hanging fruit for the IRS. If you're going to get one, do it right, because at some point of some time, they're going to come look. If you already have one, and this presentation has led you to believe that you might not have been doing it right, set an appointment with Juan. It's free to do, and he'll help give you some education and some ideas that might be able to set you on the road to fixing it, before it gets too bad. I know it's kind of a thick subject, especially with all the bills and all the stuff looming over everything, but hopefully this has been a little bit helpful. Oh, I forgot the slide. By the way, a 401k is vested, or how we take title to things is completely different, than an IRA. Typically with an IRA, it's Quest IRA for the benefit of John Doe IRA 1, 2, 3, 4, 5, whatever it is. In this case, you typically give the 401k its own name. Maybe if you had Jones Consulting, you might call this Jones Consulting 401k plan, comma, semi-comma, Bob Jones trustee, or sometimes just Bob Jones as trustee of the Jones Consulting 401k plan. And it has its own EIN separate from Jones Consulting. Remember at Quest, there's all types of things that we can buy and hold in IRAs, direct purchase of real estate, we can loan money, and we've always been able to hold all types of private entities. And this is the area that's under attack right now. And hopefully we'll be able to change that. But there's no attack right now on holding real estate or promissory notes. And we'll be doing those for a long, long time to come. If you guys ever want to get more information, there's different ways to get in touch with us. Live chat, you call us or email. I'm going to tell you something. You call Quest, and there's going to be a person that picks up the phone. You won't have to push a button to get to somebody. If you get a chat box that pops up when you're on the website, it's a real IRA specialist at the other side of that chat. You won't find a chat box at midnight on Friday. It's not how it works when you have live people. If you email, you'll be responded immediately by someone that's intelligent and knows this business and knows what they're doing. And remember, all our education services, all our consulting is free, whether you're a client or not. We know that if we get the right education out there to you, we'll eventually earn your business. Hey, you want to tell us a little bit more about QuestCon? You want me to do this? You're better at this, Haley.
Yeah, can we go through? We have a few more questions that just came in, actually. So 2 more questions, at least for right now. One of them, this is a good one. Can you transfer from an employer Roth 401k to a Roth solo 401k when you leave the job?
Yes, as long as you didn't Texas two-step it. As soon as you move it to an IRA, you're done. Right? It has to go directly from that employer plan to the employer plan. That is the only way to keep a Roth, move money into a Roth 401k. Great question. Thank you, whoever that was.
Mm-hmm. And then one more question here. This is a good one. Can you hire someone to do the admin on a individual 401k account?
Sure. There's people out there, but it doesn't come cheap. Right? And I've never seen an adequate program or something to deal with it. So it's awesome. It's just something that you have to calculate as what part of your cost. But yeah, there's definitely people out there. John Heyer would know a bunch. He knows a lot of people, that be able to put you on the right things.
Mm-hmm. Awesome. All right, guys. So really quick,
I was just looking at this guy's card right now. I think Seth. He does that type of stuff.
Oh, yeah. Oh, yeah. So guys, reach out to either Logan or myself or Juan if you want any of that info. But let's talk about QuestCon a little bit again. I know we have a lot of people that signed on after my initial announcements, but QuestCon is our next big online conference that we'll be hosting. It is all day December 3rd and 4th of this year. And the theme of this QuestCon is Forecasting 2022. So if you've been following us for a while, before COVID, we actually hosted a really big Quest Expo. It was a big in-person 700 person expo. And obviously we haven't been able to do that for about the last 2 years. So the next best thing that we have for you guys is QuestCon. It's basically the closest thing that we can do to an expo, completely online. And we're going to have a lot of great speakers join us. Now, I do have a little deal for you guys that I actually didn't mention at the beginning, since I was already covering so many things in those announcements. But if you are not currently a Quest client and you're interested in getting started, then for any new account that gets open month of October, we'll actually give you a free ticket to QuestCon. And not only that, but once you're a client and you have your QuestCon ticket, you'll also get a free copy of the recording. So that's about $100 value. Anyone who opens an account within the month of October can get that promotion. Just reach out to us. we're more than happy to help. Send us an email or chat us up through the website. Really easy to get a hold of us there. But QuestCon will be a great event. I am personally working on booking all of our speakers right now, as well as the flow of the agenda for the event. So I can let you guys know it's really going to be a good one. And we'll be gearing up for that for the next couple of months. So you'll probably hear us talk a lot about it, and just reach out to us if you have any questions. That's all I got for QuestCon.
That's all you got?
Yeah. But we do have some other upcoming events for you guys. Be sure to check those out. You can find them all on our website. If you go to questtrust.com, click on events, click on the territory or webinars that you're looking to attend, and you can find everything online there, including QuestCon as well. Nathan, do you have any last kind of closing thoughts or last piece of advice?
I just my theme for this year is think about who you're going to do business with. It's been so important over these last 18 months. I know for me, surrounding myself with people who have good moral values and putting that ahead of everything else, really has helped lend to a lot of longevity. And I think just remember that it's anybody can do all types of jobs, but if you surround yourself with people that care about what they do, they're not always the cheapest. They're typically not always the most expensive, just like Quest and its people. But, if you keep the professionals in your life, you're more likely to have less.
Oh, Nathan, it looks like you might have froze.
Woo.
You're back.
I don't know what happened.
I'm done. Yeah, you definitely cut out for a second.
Yeah, like it totally cut off. I don't know.
Mm-hmm. All right. Awesome. Well, I think you were repeat that last part of what you were saying just one more time.
I think it's so important to surround yourself with good people. I think Quest is full of good people. If you don't, I might be biased, but ask some of the other people that you meet out there. I think that most people find us to be pretty upfront and old-fashioned in the fact that we like to answer their phones and be there when you have a problem.
Mm-hmm. Awesome. Well, I think that's a great point to end today's class on. Guys, I hope you all learned something, especially for all of you self-employed individuals out there. There's some really great opportunities with these accounts to make larger contributions, have the ability to avoid UBIT altogether on your investments if you've got a solo 401k, and a lot of other various benefits there. So if you have further questions about these accounts, give us a call, send us an email, chat us through the website. We did just plug our contact information in the chat there just one more time. And be sure to join us for our other upcoming webinars this week. We've got our Self-Directed IRA Social in Houston tonight. You can also watch that presentation online. And tomorrow night on October 6th, we'll have our virtual networking happy hour completely online through Zoom as well. So hope to see you guys at some of those events. And if you have questions, just let us know and we'll be happy to help. Thanks, Nathan.
When's the last time someone told you you're the best?
Not recently enough. Just kidding.
You're definitely the best. Thank you, guys.
Thank you. All right. Y'all have a good day, everyone.